Hello financial fans, welcome back to another stock analysis. Today we'll be covering McDonald's stock ticker MCD. McDonald's is a multinational fast food company that has a widespread presence worldwide. It operates a vast network of restaurants that specialize in offering quick service meals and a diverse menu including iconic items like hamburgers, fries, chicken sandwiches, salads, and beverages. With a focus on affordability, convenience, and consistency, McDonald's aims to provide accessible and satisfying food options to customers of all ages and preferences. The company's commitment to quality, efficient service, and global branding has made it one of the most recognizable and successful fast food chains globally. The company is currently setting a market cap of $210 billion, and in 2022 they generated a revenue of $23 billion. And the dividend yield is currently sitting at 2.13%, and they're a dividend aristocrat. 38% of their revenue comes from the USA, 53% from international operated markets, and the remaining 9% from international licensed markets. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company, and we'll be using a standard margin of safety of 25%. That can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we're going to look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and light green will mean a 5% deduction from margin of safety. The first two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has gone up over the years, gone from $8.5 billion in 2013 to $10.3 billion in 2022. The average EBIT growth during this period has been 2.9% on average, which is no change in the margin of safety. The margin has also increased significantly, going from 30% in 2013 to 45% in 2022. The average margin growth is 4.6% on average, which is a 5% deduction from a margin of safety. The next two ratios that we'll be looking at are the dividend growth and the payout ratio. The dividends have gone up over the years, going from $2.80 in 2012 to $6.08 in 2023. This is a 7.1% annual dividend growth on average, which is a 5% deduction from margin of safety. This with a payout ratio sitting at 62.3%, which is no change in the margin of safety. The final two metrics that we'll be looking at are the debt to EBITDA ratio and return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. And for McDonald's, this is just over 3 years, in this case a 339% debt to EBITDA ratio, which is a 5% increase in the margin of safety. The return on invested capital for McDonald's is very solid, sitting at 18.8%, indicating that the management is very successful at allocating capital, which awards them with another 5% deduction in the margin of safety. Looking very good so far for McDonald's. Let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model that we'll be using is the discounted cash flow model. I've imported free cash flow of McDonald's going from 2014 to 2022. The average growth rate in their free cash flow annually during this period was almost 6.5%, and I'm projecting expected growth rate in their future free cash flow of 6% for the next 10 years. With this percentage, we'll determine the future free cash flow of McDonald's and determine a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 8.5%, leaving us with a sum of free cash flow of $121.6 billion. And then to get our equity value, we have to add the cash and equivalents and subtract the debt, leaving us with an equity value of $76.2 billion. Dividing that by the amount of shares outstanding, we get a discounted cash flow price per share of only $104.39, which is almost a 64% downside out of this model. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts of McDonald's going from 4 years ago to the current year. On average, the growth rate in dividends during this period has been 7%, and I'm projecting the same 7% in all of their future dividend growths. And we'll once again be using a discount rate of 8.5% in this valuation, giving us a dividend discount model price per share of $433.71, which is a 50.5% upside out of this model. The third model that we'll be using is Graham's revised valuation formula. In this model, we take a look at the earnings per share that McDonald's is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the standard yield of AAA corporate bonds, always sitting at 4.4. and we go by Benjamin Graham's theory that the PE of a company with no growth is always sitting at 7. Looking at all of these metrics, we get a fair value then out of this model of $142.60, which is a 50.5% downside from the current price. The next model that we'll be using is the multiple valuation. In this model, we take a look at similar companies to McDonald's, look at their stock price and earnings per share. This way, we can determine the average PE multiple in the industry, which in this case is sitting at 33.76. All that's left to do to get a fair value out of this model is to then multiply by the earnings per share that McDonald's is generating, which is $9.29 a share, giving us a fair value of $313.59, which is a 8.88% upside of this model. And the last model that we'll be using is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine this are the dividend yield and the PE ratio. In this case, I've imported the dividend yield of the past 5 years, and on average it has been sitting at 2.19%, while the current yield is sitting at 2.13%, indicating that it's currently slightly overvalued on this metric. Doing the same with the PE ratio, the average PE ratio of the past 5 years has been sitting at 27.01. While the current PE ratio is sitting at 31, once again indicating that it's currently overvalued on this metric as well, giving us a fair value of $265.83, which is a 7.71% downside of this model. If you want to get access to all of the models that I use in my videos and much more, you can check in the description from my Patreon link. Anyways, getting the self-promotion out of the way, let's go look at the final overview of a valuation next. Looking at a final overview, we've imported discounted cash flow, discounted dividend, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $252.02. A margin of safety we've determined earlier, using a standard margin of safety of 25%, adding 5% for the debt to EBITDA, and deducting it by 5% for the margin growth, return on invested capital, and dividend growth, leaving us with a margin of safety of only 15%. Applying this margin of safety, we then get a fair value of $214.22, and with the current price of $288.05, we get a downside of 25.63%, indicating that it's currently a sell. If there's any other companies that you would like to see on this channel, please let me know in the comments, and thanks for watching.